Hey everybody, Real Estate Ninja here. Hope you're doing well. Gonna talk about a story out of Commercial Observer today, and it's about CMBS. And remember, whenever we're talking about CMBS, which stands for Commercial Mortgage-Backed Securities, we are really talking about all of real estate. The reason why is because as this commercial mortgage-backed securities crisis, which it is, you just don't know it yet because it is not in the mainstream news, but it is the reason why these banks are failing right now. And the proof is when the breakup of these last 3 to 4 banks were happening and the FDIC was trying to sell off, liquidate the assets of these banks. The one asset that none of the banks wanted from the last 2 banks were the commercial mortgage-backed securities. Sorry, 3 banks. Commercial mortgage-backed securities. That is the big deal. And sorry, one of those 3, the last one has not officially failed, and it's because, well, they're trying to hide the mess, to be honest with you, because the run to security and the flight out of banks right now and bank deposits is immense. This is insane. M2 money supply, which is the account for all money that is sitting in checking accounts, cashier's checks, savings accounts, and things like that, is literally fleeing right now into money markets and other safe haven asset classes. And what's funny is I do not consider a money market account a safe haven asset, but a lot of people do because their safety is a fight against inflation. So they're trying to beat inflation when in all reality, it's a lot bigger than that. And people should be concerned with the money that's actually in their bank. But hey, don't ask me, ask the people in Cyprus and Greece how they feel about that. All right, so let's get into this story. It's entitled Moodys, 84%. This is what Moodys are saying. 84% of maturing commercial mortgage-backed security office loans to face refi challenges in 2023. Moody's expects the banks won't refinance most of the fixed-rate conduit loans due this year. It says here 90%, nearly 90% of commercial mortgage-backed securities office loans maturing in 2023 will face refinancing challenges, according to new data released by Moody's Analytics. While the fundamentals of the economy remain strong, commercial real estate sales volumes, lending volumes, and asset values are declining in the first quarter of the year and are not expected to pick up so long as interest rates remain high. Remember this, when it comes to commercial mortgage-backed securities, they are not amortized over, or the loan terms are very, very different than residential mortgages. And the reason why is they have higher interest rates than a residential mortgage, obviously, but also they are set up to where they have to be refied after a certain amount of years. You don't get just a 30-year fixed on a commercial property. So every 5 or so years, these companies have to refinance their debt obligations in these commercial mortgage-backed securities. Now, in the past, since let's say 2007, this has not been a problem because rates were going down and they were ultimately ultra low, except for that little bump in 2015 to 2018. But the Federal Reserve quickly did an about face and returned back to lower rates. This time they can't because they're dealing with inflation. So these companies are going out right now. Now think about it, how if you're a CFO of a major company, what you're looking at. My office building is pretty much empty because I've got all these employees doing remote work. I don't even know why we have the building. Probably just one big massive filing cabinet, right? Just keep all our files there. And now we're faced with this. So I've got this obligation that I don't need to be paying, but whatever, we're still making profit. So I'll keep paying it, right? Just like before. Who cares it's empty? Until all of a sudden, what do you mean we have to refinance? And that rate is insane. We can't afford it. That's what they're thinking. And they're going, oh my gosh, that payment is insane. We've got to get rid of this building or do something. And a lot of companies are faced with such tight margins. They're so small that they're going, okay, we just have to stop paying. And we've been seeing that all across the country. And that's why none of these banks want any of the commercial paper, because they know how big of an apocalypse this is. This is literally worst case scenario. And it's cool because I've been talking about this for a couple of years on the other channel, Economic Ninja, but it has gone widely unreported. Why? Because it is so big and it is going to take down the banking system that the mainstream media do not want you knowing this, okay? Because they want all those sheep just happy until the day everyone's screaming and yelling. So it says here, the gloomy conditions about the state of CRE, or commercial real estate, capital markets came Thursday afternoon during a Moody's first quarter 2023 CRE quarterly economy briefing, which featured analysis on the overall economy together with targeted breakdowns of various CRE asset price spheres, and capital markets activity points. The most discouraging data, surprise, was from the office sector. Approximately 84% or 7.8 billion in fixed rate CMBS conduit loans for offices that are set to mature this year are likely to face difficulties when they are tried to be refinanced, according to Kevin Fagan, head of CRE Economic Analysis at Moodys Analytics. Now, you may be looking at a 7.8 billion figure and think that's not that big of a deal, Ninja. We've seen bigger crashes like that. Excuse me, in mortgage-backed securities. I want you to understand, when mortgage-backed securities started collapsing, that happened in 2005. And it started with a small number, and then it gets bigger and bigger and bigger. Think about dominoes, and you line up the dominoes, but all the dominoes aren't the same size. What happens is those dominoes start really small, and every domino, they get just a fraction bigger, just a fraction bigger. And the force it takes to knock over that next larger domino is enough, because that next domino is just so much bigger, just slightly, but the momentum from the smaller domino is enough to take it out, and so on and so on and so on. So you start with a small domino right down here, a little small one, and by the time you're over here, you're at really tall dominoes. You're going, how did this happen? That's exactly what's happening in this market, okay? So it's absolutely big. As a matter of fact, the entire CRE market is just mind-boggling big, okay? So there's a lot of room for crash here. Now, it says, now this is from Kevin, ultimately, not all these loans are in the 84% will default or be liquidated, Fagan said. Some owners will find new equity to save quality assets. Think about what he just said here, to save quality assets. So they already know they're in a situation where companies are having to let go of assets, all right? So they're gonna be able to save some quality assets. And some borrowers will get extensions and workouts as we work through this down cycle. Now think about what he's saying. Saving quality assets, which means they're losing some, and some borrowers will get extensions and workouts, which means they're not able to make their payments, all right? And then he also says through this down cycle. That's three things in one sentence where you know that the author or the speaker is telling you we are in a crash. But the thing is most people don't know how to identify that stuff, and they read this real quick and they just go, whatever, it's just a couple of businesses that are having some strain, some trouble. It's not that. It is much bigger. It says national office vacancies reached 19% in the first quarter of 2023, according to Moodys, a level not reached in nearly 30 years and close to the historic high of 1991. This is a big deal. That means it was worse than what led up to 2008. Okay, that is bad. It's going to get worse. And in 1991, that historic rate was insane, which led us into a recession going into 1994, and it was a big deal. That occurred following the savings and loan crisis of the 1980s and the early 1990s. So you see the time lag that it takes these companies to finally stop paying on their rents. They go through lots of trouble, they get extra debt to try and mask over or band-aid over that trouble, and then eventually they end up defaulting. And that is where we're at right now, and that's why I've been warning people for the last couple of years on this, because it is a big deal, and it's gonna lead to one of the greatest real estate crashes in history. Now, if you wanna take advantage of that real estate crash, I'll put a link to my course below, 70% off, but it's important to be able to start putting your lining everything up, because if you do not do that and you're not prepared and you don't have the right amount of savings, you don't have the right mindset, and you don't have the either lower debt or the right type of debt set up before this happens, you are not going to be ready to take advantage of this, and you are going to miss out. This will be the greatest opportunity of your lifetime to buy cash flowing real estate for pennies on the dollar. I'm not joking. This is going to be exciting. The banks are getting ready for it. BlackRock has no problem building the largest real estate downturn fund in history right now. I think it's up to $30 billion. Now think about that. Where we're talking about Moodys, talking about commercial real estate, and there's $7.8 billion worth of loans right now that are looking to have to reset, but BlackRock has a $30 billion fund to scoop up real estate and distressed assets. It gives you an idea of the entire scope of what is going on, how these bankers are getting ready, and you are not. It's important. Guys, I'll put the link below to the course. If you have any questions or what you're seeing on the in the real market, please put it down in the comment section. I'd love to read your comments and get ideas for future videos. All right, with that being said, not the economic ninja, I'm the real estate ninja, is out.